Hey guys, how's it going? It's Russell Matthews here, and people are constantly told that they should start investing. And you know what the first thing is that pops into someone's mind when they're told this? They either think of some guy working at a bank trying to sort through some complex algorithm, or on the other hand, they think of some asshole guy who's just only out for himself, like Wolf of Wall Street. And with this sort of imagery in your head, it's easy to A, never start investing because you think it's some super complex thing that only geniuses can do, or B, on the other hand, you develop some anti-investing moral stigma against investing at all. And while those two stereotypical kind of images do exist in the real world, I'm here to tell you that is not the only way to do it. You should really be thinking of investing as like planting a tree, and you do a little bit of work up front, but over time it's going to be hands off and slowly you're going to watch that tree grow. That's what investing should be, and it really is as easy as that. With the right approach and the right strategy, you can set it up so you can set it and forget it and not have to look at it every single day. This is what I did while I was saving up the money for my down payment on my current househack investment property that I'm living in now. So today we're going to go through the super simple steps that can help you actually get started investing in this sort of set it and forget it framework, and not have to worry about it, and also not have to hear people nagging you all the time. You need to start investing. You're already going to be doing it. With that being said, if you wouldn't mind doing me a quick favor, just click that like button because it really shows so many more people the video because of the YouTube algorithm. First of all, there are tons of different ways to invest, and if you've watched anything on my channel, you know I'm big into the real estate world. But for people who are just starting out, I'd rather go with a strategy that you can just simply do from your laptop anywhere at home, super simple, nothing complex or anything you're going to have to work at for years to make happen. So instead of investing in individual stocks or in real estate or in something else, today we're going to be talking about investing in index ETF funds. That's exchange traded funds. So let's get into it. The first thing you're going to want to do is set up a self-directed investment TFSA account. Now this is super easy to do, and you can do it at most of your banks that you're already at. Most online brokerages will charge you some sort of fee per trade, like maybe from $4 to $9. But there's actually accounts that you can make and that you can set up that don't have any fees for specific kinds of trading, and it just so happens that's the kind of trading we're going to be doing today. One of the places that allows you to purchase ETFs for free is Questrade. Now, if you haven't heard about Questrade, you can set up an account. I'll leave a link down in the description of this video, and you can actually use this platform to buy what we're going to buy as our investments. Questrade offers all ETF purchases for free, with fees only for selling the stocks. So this is good for our strategy because we're not really going to be planning on selling these stocks very frequently. And yes, most banks have their own sort of version of this. I know I used CIBC for a very long time, but there are some fees sort of attached to your buying and selling. And if you're working in smaller amounts, these fees can really eat into your overall returns. No matter where you open up your account, you're going to want to open up the TFSA version of the investment account. That's your tax-free savings account, as opposed to the options that aren't a TFSA account. This is an account that will allow you to not have to pay taxes on your gains for your investments. So since you have it available to you, you should definitely use it. However, there's a limit for how much you can actually put into these accounts based on how long you've been 18 is the way they do it. So you should check out this calculator that's on this MoneySense website. I'll link it again in the description, and you can find out based on my age and based on these other factors, how much room do I have to put in. Most of the time it's not going to matter if you're just starting out anyways. If you're in the awesome situation that your TFSA is already maxed out, then there's another account you can open called an RRSP, and we'll talk about that later, but that's just another one where it can be helpful for tax implications. Once you've opened up your self-directed TFSA investment account, woohoo, congratulations, now you can actually buy things and sell things on the stock market. However, and this is contrary to some people's belief, I wouldn't recommend buying individual stocks. Stocks for individual companies can go up or can go down based on a huge amount of factors, and most people don't really have the time to go diving through and combing through the financials of the company to see if it's a good buy. Instead, I think it's best to invest in index ETFs. Now, the index side of index ETFs means that instead of buying an individual stock for a company, you're buying something that's kind of like a whole bunch of stocks all at once, but just little bits of them. Think of it as a guy at a grocery store just walking down the aisle saying, oh, I'm going to grab a little bit of this company, a little bit of that, and putting it all into his grocery cart. Instead of buying the individual items, you're buying the cart as a whole, this bundle of a bunch of different companies. The main benefit of this is that instead of buying an individual stock, you've got a bunch of them. So if one individual company goes way down, something terrible happens, your losses aren't going to be that huge because your portfolio is diversified across a bunch of different companies and they could have done well that day. So it kind of evens it out. These index funds kind of work in a similar way to how mutual funds work, which is something you might have heard of because it's something that was super popular, I've noticed, with a lot of people in that boomer sort of age. Okay, boomer. Everyone thought, oh, mutual funds are the way to go. I'm not a huge fan of mutual funds because instead of index funds, they actually have somebody who's actively taking items out of the cart and putting different items in, trying to boost up the returns. Here's the thing, most people who choose which stocks are in the fund, they actually can't do better than an index fund in terms of percentage of return. And this is the vast majority of times. So you're paying them extra money to get the same or potentially worse results. And now in the fringe cases where they actually do beat the market and they give you a higher return, they're still charging you, so it kind of negates that extra added benefit. So in my mind, it's always better to go with an ETF, that's an index fund, over a mutual fund where you've got to pay these fees. The ETF part of the index ETF fund, it stands for exchange traded fund. This just means that you can buy this index super easily. It has a stock ticker symbol just like any other stock, and you can buy it right inside of your actively managed investment TFSA account. All it takes is a few clicks once you're in Questrade or whatever investment brokerage you use, and automatically, boom, like that, you can have that index in your portfolio. The next step is deciding which index fund you actually want to buy. Different index funds have different items in the cart, so you'll want to make sure that you pick the one that's right for you. But how do you know which one's right? To help you decide, there are some great charts on the website Canadian Couch Potato, which is the website that initially got me into ETF investing when I was a teenager. So this chart is telling us about some index funds that are either more aggressive and a little bit more risky, or less aggressive and a little bit more safe. They can make funds that are either more or less risky or volatile by balancing the amount of bonds that are in the fund versus equities, and that's just stocks. And bonds are generally a less risky form of investment, so if you throw those into your cart, the cart as a whole is a little bit less risky. For example, you can see here, this one is 80% bonds, 20% equities, so it's less risky. And over here, it's 20% bonds and 80% equities, so it's more risky. For this ETF, that's kind of more stocks inside of it, you'll notice that on its really good years, it does really, really well, and on its really bad years, it does pretty poorly. So that's why it's a little bit more volatile. But you look over here at the less risky one, more bonds in it, its returns are generally more stable. You don't have those crazy highs, but you also don't have those crazy lows. So you're going to want to figure out which risk tolerance you're looking at and what you're comfortable with. And again, I'll link the charts like this down in the description so you can find them there. If you're watching this on anything but YouTube, head over to YouTube, you can find the links there. Once you decide which ETF you want, you can go back to that chart and take the stock ticker symbol for that ETF, and that'll be like some letters like VCIP, VCNS, VBAL, VGRO. You can take those and go into your brokerage account, maybe it's on Questrade, maybe it's on something else, and you can type in those letters to find that ETF in order to buy it. You can buy however much of it that you want, right? Different people have different amounts of money to invest at different times. Some people like to set it up so that there's a constant draw from their bank account that goes into their investment account, and you can set that up for yourself. It's always good to be constantly adding to the account, though. This is one of the most important parts of this strategy. Listen up. Once you've bought it, stop looking at your account. It's so easy to get emotionally attached to the ups and downs of your portfolio, but this is not what we want to do. We don't want to let our emotions control how we invest. Our strategy really thrives on the long term. Even if there's a huge 30% market downturn, your whole portfolio goes down, do not sell, because really you haven't lost any money until you pull the trigger and until you sell off of your portfolio. don't let your emotions get the best of you, and don't sell when this happens. You're screwing yourself out of money if you do. Just stay calm, have faith, stay the course, and over time, the market will bounce back up to even above where it was before. After a crash, the markets will eventually go back up. It's happened every single time as long as you give it enough time. If you panic and sell, well, now you've realized those losses. Since this is a long-term strategy, I really recommend only putting in money that you don't need right away. I always recommend starting up some sort of account that has an emergency fund in it. But if you've got your emergency fund set and you're ready to start investing, then feel free to put as much of your disposable income into this as possible. Before I was ready to buy my house, this is exactly what I did, and the market helped me out a little bit and sped up the time that it took for me to save up for my down payment. As it got closer and closer to the day I would need that down payment, I started taking some of the money out just to make sure that there wasn't some huge crazy stock crash right before I needed the money, so that I wouldn't have to realize those losses. But yeah, the point is just leave the money there. Don't think about it. Just leave it. You might be thinking, but Russell, what if my stock portfolio goes down? Well, I can just see this, it's going down. I need to sell it. I'll buy something else that's doing better. No, just relax. And there you have it. This is how I recommend you start investing. Now, of course, this isn't entirely comprehensive. This is just the thing that I recommend to beginners trying to get into it and trying to set themselves up for the future. The beauty of it is that it's 100% set it and forget it. You don't need to be going in there and thinking about it all the time. You don't need to be combing through financials like some financial whiz, right? Like, this is a good thing that will take only about a couple hours at the start, and you can just watch that tree grow over time. So with that said, thanks so much for watching, you guys. I really appreciate it. Make sure to hit that subscribe button, hit the notification bell, and you can also add me on Instagram too. I post there every now and then, so if you want to stay connected, you can hit me up there. Let me know if you decide to start up an investment account and how it goes for you. But that's pretty much it for me, guys, so I'll see you next time.